Hey everyone, and welcome to this explainer. Today, we're zeroing in on Zoom's August 25th, 2026 Q2 earnings report. But listen, we aren't just going to glance at a basic earnings beat and call it a day. No, we're going to unpack this really fascinating, kind of strange paradox surrounding Zoom's current financial reality. Because right now, there's a massive disconnect between the sheer amount of money this company is raking in and how Wall Street is actually reacting to it. And by the end of this explainer, you're going to understand exactly why. Okay, let's dive into this. Zoom just reported their earnings, and honestly, by almost all traditional measures, they absolutely knocked it out of the park. They're highly profitable, they're generating enormous cash flow, they're expanding heavily into AI, and they're scooping up these big enterprise customers left and right. But right after the report dropped, Zoom's stock actually fell about 3.8% in extended trading. The market just didn't celebrate. So if they're doing so incredibly well, why all the skepticism? Is Wall Street just completely missing the boat here? Or is Zoom fundamentally changing in a way that investors just don't quite get yet? To really see this disconnect, you just have to look at the headline numbers. Zoom brought in a massive $1.277 billion in Q2 revenue alone. And their adjusted earnings, which is basically their profit minus one-time expenses, giving us a really clean look at their core operations, came in at 1.55 per share. That easily cruised past the 1.48 that Wall Street analysts were expecting. Plus, they generated nearly $500 million in free cash flow in just a single quarter. I mean, these are huge, highly profitable numbers that most software companies would literally kill for. Yet, we still saw that negative market reaction. So to solve this mystery, we realize we can't just look at the raw revenue. Section 1. The post-earnings mystery. To really solve this, we've got to look at the growth rate. And frankly, this is where the investigation gets a little uncomfortable, especially for investors who still picture Zoom as that pandemic-era rocket ship. Look at their year-over-year revenue growth over the last 3 quarters. We're seeing 5.3%, then 5.5%, and those recently 4.9%. Now sure, the overall direction is an improvement from that immediate post-pandemic slump we all remember, but the reality is staring us right in the face. Zoom is no longer a hyper-growth software company. It's a mature company, and it's plateauing at around 5% growth. And that right there brilliantly illustrates a major puzzle. Because if you're only growing at 5%, why on earth should investors value you like some aggressive, world-changing AI growth stock? Well, to answer that, we have to look at where that 5% is actually coming from today. Section 2. Beyond just video meetings. Because honestly, the Zoom you think you know, it's disappearing. For years, investors tied this company to one single thing, video meetings. But as the world opened back up, video meetings became totally commoditized, heavily pressured by tech giants giving away video basically for free. So Zoom pivoted, and they pivoted aggressively. They don't want to just sell you another meeting anymore. They want to sell your entire company a complete communications platform. And guess what? That strategy is actually starting to work. Just look at this breakdown. Enterprise customers now make up 62% of Zoom's total revenue. They're successfully cross-selling complex new products like Zoom Phone and, this is a big one, Zoom Contact Center. This contact center product is massive. They're basically going in and replacing those clunky legacy customer service phone trees with a modern cloud-based AI-driven system. In fact, the number of enterprise customers spending over $100,000 a year just reached 4,625. That's an 8% jump year over year. So they are definitely capturing the big fish. But as we know, simply landing large enterprise customers isn't enough in the SaaS world. You have to keep them growing. And that brings us to a really crucial metric in the software world, the net dollar expansion rate. Basically, this measures how much revenue you retain from your existing customers over a year, factoring in all the upgrades, downgrades, and cancellations. It answers one simple question. Are your current customers spending more with you today than they were a year ago? Well, right now, Zoom's enterprise net dollar expansion is sitting at exactly 99%. And that's a critical clue. At 99%, Zoom is essentially just maintaining the dollar value of its enterprise base. They aren't shrinking, which is great, but they aren't crossing that magical 100% threshold that signals explosive organic expansion either. Section 3. The high-stakes AI bet. So how exactly does Zoom push that 99% expansion rate over 100%? Well, they're making a massive, super high-stakes bet on becoming an AI-powered workplace platform. And I gotta say, their early traction on this AI bet is genuinely impressive. Zoom's AI feature monthly active users shot up 125% year over year. Customers using Zoom Revenue Accelerator, up 41%. And crucially, they've now surpassed $100 million in AI-related annual recurring revenue. That means highly predictable, locked-in subscription money they can count on year after year. They're even seeing that 9 out of their 10 largest customer experience deals actually involved paid AI components. But here is the catch that every investor absolutely needs to remember. AI adoption is not the same thing as AI monetization. Getting people to use a free AI meeting summarizer is one thing. Getting huge enterprise clients to pay a premium for complex AI workflow tools, that's a whole different ballgame. And this leads us right into the biggest hurdle standing in Zoom's way. See, Microsoft doesn't have to build a user base from scratch. They already have Teams. Google has Meet. Both of them can just bundle their communications and AI tools into their much larger already existing ecosystems. Think about how Microsoft operates for a second. They can walk into a Fortune 500 company and say, hey, you're already paying for Word, Excel, and Azure. We'll just throw in Teams and our AI Copilot for a fraction of the cost, or maybe even for free. It is an incredibly powerful bundling strategy. So the multi-billion-dollar question for the stock is whether Zoom can monetize its specialized AI workflow tools faster than Microsoft and Google can just commoditize this exact same features through their massive enterprise bundles. Section 4. A massive cash machine. Now, what's really interesting about these numbers is, well, before you completely count Zoom out against big tech, we need to shift our focus to the metrics that beginners almost always miss. Because if you're only looking at that 5% revenue growth in the intense competition, you're totally missing the fact that Zoom is an absolute financial fortress. Look at this staggering 40% non-GAAP operating margin. That means they are keeping a massive chunk of their revenue as pure profit from their core operations, stripping out non-cash expenses. I mean, let that sink in. They also boast a 37% free cash flow margin, generating nearly $1 billion in pure free cash flow in just the first 6 months of the year alone. This isn't some struggling startup burning through cash trying to find a business model. This is a highly optimized profit machine. And because of that incredible profitability, Zoom is sitting on an absolute mountain of capital. We're talking $7.2 billion in cash, cash equivalents, and marketable securities. And here is the kicker. They have absolutely zero meaningful debt burden relative to this cash position. From a credit perspective, they are virtually untouchable. Think about it, a 5% growth company that needs external financing in a high interest rate environment, that's a really risky bet. But a 5% growth company sitting on $7.2 billion in cash with no debt, that is a completely different, highly resilient investment profile. Let's see how this builds real shareholder value, because Zoom is aggressively using all that cash to buy back its own stock. Right now, they have a massive $4.7 billion share repurchase authorization in place. By buying back 44.2 million shares since Q1 of FY2025, they've actually reduced their diluted share count by roughly 2.8% year over year. Let's do the math on that for a second. Revenue grew 4.9%, but the number of shares shrank by 2.8%. So the per-share economics are improving much, much faster than that headline revenue number might suggest. They're basically taking a slightly larger pie, and they're dividing it into fewer and fewer slices. Section 5. The bull versus bear. So with the stock trading in the low $100 range and a market cap hovering around $30 billion, we've got this really fascinating situation where investors are split into two totally different camps. Let's weigh the evidence objectively here. The bull camp looks at this and sees a wildly profitable software company with $7.2 billion in cash, massive free cash flow, aggressive stock buybacks, and surging AI adoption, all while trading at a valuation way below its historical highs. Pretty compelling, right? But then, the bear camp looks at the exact same company and sees a business stuck at 5% revenue growth, fighting brutal, heavily subsidized competition from Microsoft and Google, and offering Q3 earnings per share guidance that actually missed Wall Street's estimates, kind of warning of potential stagnation ahead. Honestly, both sides have completely valid evidence. So we really need to stress test the future a bit here. Ask yourself, what happens if revenue simply stays at 5% for the next 5 years? I mean, forget the AI hype, forget the pandemic glory days. Just picture a steady 5% growth. If they stay at 5%, you don't have a hypergrowth AI stock anymore. You have a mature, highly profitable cash machine. Your investment return wouldn't be depending on explosive top-line growth at all. It would depend entirely on free cash flow, those share buybacks, and valuation multiples. It completely changes the entire fundamental thesis of why you would want to own this asset in the first place. Section 6. The final verdict. Which brings us to our final analysis. Is this stock permanently broken, or is it a hidden gem just waiting to be revalued? Look, if you're watching this stock, you can pretty much ignore the daily noise and the flashy headlines and just focus on these 3 specific numbers. First, revenue growth needs to sustainably break above that 5% mark to completely change the valuation argument on Wall Street. Second, enterprise net dollar expansion needs to cross 100%, ideally moving toward 105 or 110%, which would prove that their cross-selling of AI and new platform products is actually working. And third, free cash flow absolutely must maintain its $1.78 to $1.82 billion guidance for the year because, let's face it, that is the very engine funding their entire buyback strategy. So the crucial point is knowing exactly what would break this thesis entirely. Watch out for these 5 critical red flags. If revenue growth falls below 5% and stays there, if net dollar expansion continues to decline, if AI adoption is growing but completely fails to translate into actual paid annual recurring revenue, if Microsoft and Google start successfully pressuring customer retention with their bundles, or, and this is probably the most dangerous one, if free cash flow declines while management continues blindly buying back stock. If you see those happen, remember, even a great company can be a bad investment at the wrong price. All right, based on all the evidence we've covered in this explainer, the final verdict is a watch with a bullish bias. Zoom is absolutely not a broken company. I mean, their cash pile and profit margins are just incredible. But the market is rightfully waiting for proof that AI can actually accelerate top-line growth before it's willing to assign a higher premium to the stock. Conservative investors should probably wait for that definitive proof of acceleration rather than paying for it in advance. And just a quick side note for you income investors out there. Zoom pays no regular cash dividend. Their return strategy is 100% focused on buybacks and capital appreciation. Which leaves us with one final thought. Most people out there are asking if Zoom can survive Microsoft. But what if that's just the wrong question entirely? Zoom doesn't need to beat Microsoft, and honestly, it doesn't even need to become the dominant AI platform in the world. To be a phenomenal investment from here, it just needs to accelerate its own highly profitable engine, pushing retention over 100%, scaling that paid AI revenue, and aggressively buying back shares with its massive cash flow. So the ultimate question for you as an investor isn't about their survival. It's about whether you believe they have the power to accelerate.